Why are derivatives often cheaper to trade than the underlying asset? Imagine you believe Tesla is going to have an incredible year. One option is to buy thousands of Tesla shares, but that could cost hundreds of thousands of dollars. Not every investor has the kind of capital. Now imagine another choice. Instead of buying all those shares, you enter a derivative contract whose value is linked to Tesla's stock price. With a much smaller amount of money, you can gain exposure to the same price movements. You didn't buy the entire asset, you bought a financial contract based on it. This is why derivatives are often cheaper to trade than the underlying asset. You're not paying for the full ownership, you're paying for the price exposure. That makes derivative a more capital efficient way to participate in the financial markets. Think of it like renting a luxury sports car for a weekend instead of buying it outright. Buying a car requires a huge amount of money. Renting it lets you experience it for a fraction of cost. Similarly, derivative let investors participate in an asset's price movement without paying the full purchase price. Of course, lower upfront cost doesn't mean lower risk because you are controlling a much larger exposure with less money. Gains can be much larger, but so can the losses. That's why professional investors use derivatives carefully.